Good evening, and welcome to today's financial market report. Let's start with Wall Street last night. The three major indices closed with minimal changes, essentially flat. The Nasdaq finished at 24,932 points, the S&P 500 at 7,413 points, and the Dow Jones at 52,210 points. However, pre-market futures are showing positive momentum, with Nasdaq futures up 0.44%, S&P futures up 0.5%, and Dow futures gaining nearly a full percentage point. This suggests the market is trying to stabilize after the sharp sell-off in Chinese stocks yesterday. Looking at individual stocks, the Bitcoin ETF gained nearly 2%, and MicroStrategy rose 2.64%, indicating some recovery in sentiment around digital currency-related names. But Nvidia only edged up 0.19%, showing the AI leader remains weak. The ARKK fund, which focuses on growth stocks, fell 0.21%, confirming that growth names are still under pressure. On the global macro front, we are seeing clear risk aversion signals. The U.S. 10-year Treasury yield stood at 4.633%, down 0.17% overnight. The decline in yield suggests that capital is flowing into treasuries as a safe haven, with liquidity expectations leaning toward easing, but the move is limited and not a trend reversal. The VIX Volatility Index came in at 18.71, briefly touching 20 during the session. This is in the upper end of the normal range, indicating caution rather than panic. But if it closes above 20 today, we would upgrade to panic level, so keep a close eye on that. The dollar index was at 101.51, edging lower overnight, maintaining a weak and choppy pattern. A weaker dollar is generally supportive for emerging market assets, but today that relationship may be temporarily disconnected due to the sharp moves in Chinese stocks. In commodities, WTI crude oil fell 1.1% to $81.13 a barrel. The main reason is that Saudi Arabia within OPEC has signaled it may abandon the $100 price target, suggesting a looser supply outlook. Lower oil prices are a cost benefit for airlines and transportation companies, but directly pressure energy stocks. Spot gold was at $4,034 an ounce, down slightly. Gold hasn't rallied despite the risk-off environment, which suggests capital is favoring cash and treasuries over traditional safe haven assets, hinting that the market may be worried about a liquidity shock rather than geopolitical risks. To sum up the global picture, we are in a clear risk-off mode. The condition for this to ease would be if Nasdaq futures expand their gain to more than 1% and the VIX drops back below 17. Now let's turn to the renminbi and the external environment for Chinese assets. The onshore yuan was at 6.7595, and the offshore yuan at 6.7732. The onshore yuan actually edged up 0.11% yesterday, while the offshore yuan edged down 0.08%, both trading in a narrow range between 6.75 and 6.78. There was no sharp depreciation despite the big drop in Chinese stocks, suggesting the central bank may be using the fixing rate to maintain stability. A stable yuan helps prevent panic outflows from foreign investors, but today the deciding factor will still be internal sentiment in the A-share market and how the market digests the new share reduction rules. If the offshore yuan breaks below 6.80, foreign capital outflow pressure will increase. On the U.S.-China front, the Commerce Department's BIS expanded export controls on advanced semiconductor equipment to China, adding 14 Chinese entities to the entity list, mainly involving AI chips and high-end memory storage. Meanwhile, U.S. and Chinese trade representatives held a video call on gallium and germanium export controls but failed to reach consensus. The U.S. side threatened to impose tariffs on rare earths but gave no timeline. These developments continue to weigh on tech stock risk appetite. For today's A-share open, we expect a lower start. The direct reason is that the China Securities Regulatory Commission's new draft rules on share reductions, released yesterday, are still being digested. Combined with the semiconductor control news from overseas, the market needs time to process. Only if the Shanghai 50 index futures open with a gain of more than 0.5% could we see a flat or mildly volatile open. Looking at the A-share market itself, the Shanghai Composite is likely to trade weak and choppy today, probably in the 37.80 to 38.30 range, as it continues to digest the impact of the share reduction rules. The Chi-Next index, which plunged 7.34% yesterday, may have some technical rebound demand in the short term, but its trend has been severely broken. Any bounce should be treated as a window to reduce positions, not to buy the dip. If the Shanghai Composite opens below 3,780 and fails to recover within 15 minutes, we would shift to a call for a one-way decline. If the brokerage sector stages a collective rally to support the market, the index could trade in a narrow range. In terms of sectors, rare earths and critical minerals are worth watching. With the US-China tariff talks yielding no results yesterday, and tomorrow marking the first anniversary of China's gallium and germanium control measures, the market expects a possible new round of countermeasures. This sector has a catalyst on the horizon. Utilities and power stocks stand out as defensive plays in a weak market. They offer stable cash flows, low volatility, and are not exposed to external demand shocks, making them more likely to attract allocation from existing funds. Even during yesterday's 7% plunge in Chi-Next, the power sector held up relatively well. On the risk side, semiconductor equipment and materials face direct headwinds from the BIS entity list additions. Avoid buying the dip in the short term. High valuation small caps and micro caps are also vulnerable. The new share reduction rules hit names that rely on liquidity the hardest, and if foreign capital flows out due to the tech control news, these names will be squeezed from both sides. For northbound capital flows, net outflows are more likely than net inflows today. The fact that the yuan remained stable during yesterday's stock rout suggests external factors were not the main cause, but this morning's semiconductor control news will trigger foreign selling in tech names. If northbound flows show net outflows exceeding 3 billion yuan in the first half hour of trading, we would confirm net outflows for the day. If they show net inflows and the Shanghai Composite does not fall in that period, then net inflows are possible. Let me give you the core call for today. Global risk aversion combined with domestic policy shocks means the Shanghai Composite will trade weak and choppy. Avoid high valuation small caps and semiconductors. Our probability assessment is 20% for an up day, 50% for a choppy day, and 30% for a down day. Thank you for watching, and we will see you next time.